then the first part will go really smooth. Okay. So what we're trying to do is we're trying to arrive at the JEs, but from the financial statement perspective. That means even let's say if you don't know the rules of personal, nominal, and real accounts, how can you make any JEs? And see, in finance, in regulation, at some when you're doing the corporate taxation, and definitely in audit, it's really important. And even in bar, if you're taking bar as your add-on paper, then this is so important for you to know that everything should be broken down to JEs. Now, from this year, they have started placing a lot of emphasis on JEs. Last year, till last year, you could still have a drop-down menu and you can choose the answers. From this year onwards, there's going to be a lot of emphasis on journal entries so you have to actually write the journal entries and you have to put in the figures. Everything is going to be blank. Okay, so be mentally prepared for something like that. So today we're going to talk about two topics. We are going to first talk about how do you build up a journal entry. And sometimes I have seen some people not being able to understand how are you going to relate to I have seen people making mistakes of debiting and crediting reverse items. So how do you check yourself when you write something and you're not very sure of what you have written? Now, this part actually, if you look at most content providers, there is this part called special purpose framework. Yesterday, if you recall, we spoke about how you can have the cash basis of accounting. So, this topic, which I feel is the cornerstone for two topics actually. First is that it will give us a base of accrual accounting. So, it gives us a very good visual of all the topics that we are going to do henceforth. And the next thing is that when you do cash flows, okay, the concept that we are going to talk about today is going to help us draft the cash flow statement almost instantaneously. Okay, almost instantaneously. So if you are very thorough with this topic today, there are 4 5 questions that I have put into the session, which are all MCQ based questions. But if you're able to solve these questions really well, chances are that you would be not struggling when you're going to make your cash flow statements. Okay. Now, see, how are we going to approach the journal entries in case if you feel you're making an error? So if you want to stop yourself or you want to double check yourself when you're making your journal entries. See, we all know that our basic accounting equation is asset is equal to equity plus liability. We know that this is how the accounting concept generated. The first thing that generated was the accounting equation whereby your net equity is actually equal to your assets minus liabilities. This is the cornerstone of accounting. Okay. So, very simply put, all that you have to understand is everything that is good in your kitty is a debit, liability is a credit. When you go to risks, anything which is good in your kitty is a debit, anything which is bad for your kitty is a credit. And equity is also a bad thing for the business. Why? Because at the end of the day, this is also somebody else's claim on your business. So every time you're going to learn about balance sheet and every time you want to check yourself for an item which is a balance sheet item, just remember that an asset, anything good is debit, anything bad is a credit. And bad, when you say, is the claim that outsiders or insiders have on the business. So when I say, now we know the basic accounting. So see, everything in accounting can be done with the basic fundamental equation of assets plus liabilities. Asset is equal to equity plus liability. This can solve everything in accounting actually, guys. So everything, if you can bring it down and funnel it into this base, you will see everything has been built up on this base only. So that means, so now I want you guys to participate. That means it's a beam balance whereby at one go we put the assets and at the other place we put the equity and the liability. Both of them have been piled up in one place. And at any point of time, it will always balance. So tell me, guys, if an asset goes up, what are the scenarios that can happen for the balance sheet to die? So your asset goes up, the other asset has to come down. So one thing goes up, another thing comes down, balances. Or your liability has to also go up. So if one side increases, the other side also increases. What is the third scenario? What is the third scenario, guys? If the asset is increasing and if you want the balancing the weighing scale to balance. What is the third scenario? Very good. So it's either another asset would come down. That means at any point of time, if the balance sheet has to balance, either another asset has to come down, or a liability has to go up, or an equity has to go up. Now think of examples, guys. The first one, the first scenario. Give me an example of the first scenario. The first scenario. Give me an example of the first scenario. Uh, Okay, let's start with the third scenario first. Okay, give me an example of a scenario in a balance sheet where the asset increases and the equity also increases. Yes, asset increases and the equity also increases. Asset increases, very good. So shares are issued. So what is a journal entry? You're getting something in which is a good news. So your cash gets in, which is a good news because it's a risk statement. And you need to pay to your equity shareholders. What would be the journal entry? So this will be equity share capital account. And another thing, don't forget the APIC. Always
Oh,
there will be an APIC. Why? Because every time there's a share which is issued, the authorized share capital cannot be crossed. So people keep the fair value, the face value of the shares are kept down, and generally there would be a share premium. Always that is close. And if you look at closely at the balance sheet, the APIC will be bigger than the ESC, at least in the initial years. Okay. So what I
yes.
did, I increased the asset. So my bank increased, and at the same time, it increased my equity. So on one weighing scale, I put something else here. So this goes down, and I equivalently, it has a countervailing effect, whereas this also goes down. So again, it balances. Very good. Next question. Give me an example where an asset increases and also it leads to the liability increase. Yes, an asset increases and at the same time it leads to a liability increase. Give me an example for that, guys. Okay, so you will have machinery account debit, and typically it would be a creditor account, some kind of a creditor account, which will be, or in CPA, the term that we generally use is a payable account, right? Maybe it can be
Yeah.
converted to a note, so it can be a notes payable. Generally, it is not accounts payable. Can you tell me why? Why, when I buy a machinery, it is generally not accounts payable? Can you tell me the difference between machinery and accounts payable? Is when I'm buying goods on credit. That is the time when I hit my accounts payable, right? Generally, when it is not a normal item in your regular course of business, like we have machinery here, it is not accounts payable. So it's either it's a payable on account of a machinery, or we create a separate bucket. We don't call it accounts payable. Very good. Give me an example of one asset going up and the other asset coming down. Give me an asset of one asset going up and the other asset coming down. This is the simplest, right? I am using my cash to buy certain items. Okay, so I can use my to buy supplies, I can use my cash to buy whatever I want to, can be a debit. And I'm using, yeah, I'm using it. So it can be a current asset, it can be a fixed asset, it can be a consumable, it can be anything. Yeah, investments. Very good. So what are we doing? At any point of time, any journal entry which involves two items of balance sheet can be made if I can tell you that one asset increases. So if one side goes up, the other side also has to go up parallelly, or if one side goes up, it should balance out another item on the same side so that the equation remains constant. So this is the side, this is the discussion that talks about the increase. The same thing would apply for a decrease. Why? Because the moment we have a decrease, then instead of raising an issue for capital, we can have a treasury stock whereby we buy back the shares. Or you can have the repayment of the liability while we are settling off a loan. Or it can be a situation where a debtor is paying me the money. So I'm receiving the money. It is the same thing. I receive the money from a debtor, one debtor comes down, one asset comes down, another asset goes up. So at any point of time, balance sheet will tally. But tell me, guys, if I tell you I've paid salary, is it going to have an impact on the balance sheet? Okay. So what I'm saying is, do not go by the traditional approach of golden principles of, if you know this, excellent, because by this time it should be a part of your second nature. If you are struggling, or if you feel that you are a person who makes errors in journal entries, every time you make it for the next 1 month, just be mindful that whatever you're doing, is the equation holding true. Chances are you do it 10 times, 12 times for a month, and you will stop making mistakes in journal entries. Okay. Now I'm giving you another scenario. Let's say if I tell you that I've paid salaries in cash. Can you tell me what will be the impact on this equation because of salaries that I have paid in cash? Yes, guys? Paid salaries in cash. Okay. And I want to know what is the impact on the accounting equation. So we have salaries to cash. Now this is a P&L item which will ultimately be close to retained earnings. So here my asset has gone down, and since it's a P&L debit item, it will reduce my equity. So your equity comes down. So your asset comes down, your equity comes down, your balance sheet tallies. But what we did, we brought in an angle where the P&L also flows into the balance sheet, and ultimately it is the equation that holds true. Okay? Think of a scenario when your asset increases and a P&L credit happens. Guys, can you explain me? Give me an example when there was a credit in the P&L that led to the balance sheet tally. Can you tell me what is the example? Very common example would be when you have a sale. When you're actually crediting your P&L for sale, then your profits goes up and it impacts your equity, and your cash also goes up, or your receivable goes up. At any point of time, there cannot be a scenario where your balance sheet or your account. So remember, balance sheet P&L is our ways of window dressing. At the end of the day, there was a basic accounting equation which will always hold true. Now I'm giving you, so what we did, we spoke about some. So P&L is very simple. Any item of an expense, anything which goes to the debit of the P&L is bad news to you. Anything which goes to the credit of the P&L is good news to you. So every time there's a debit or a credit, just understand, is it good news? Is it bad news? Somehow, every time when you do it from good news and bad news perspective, you will never get it wrong. And always understand that balance sheet asset is good news, liability and equity is bad news, P&L credit is good news, debit is bad news. So what is good news? Gains and revenues. So it goes to the credit. And what is bad news? In the CPA exam, it don't use a lot of T accounts, but somehow I feel as a base, a T account should always, it's very easy to visualize a T account compared to a horizontal account. Okay. So always, if you can visualize a P&L with a debit and a credit, anything here is good news, anything here is bad news. So what is good news here? We can have items like revenues and gains, which are good news. And anything which is an expense or a loss is a bad news. Okay. And then this ultimately goes on to your balance sheet. And in your balance sheet, anything which you own, an asset is a good news, a liability or an equity is a bad news. And ultimately, the P&L closes the P&L. So when I have this, that means this is heavier, this is higher, which creates a gross profit and a net profit. And ultimately, the net income flows to the balance sheet, where you have the asset, where you have the liability and the equity. So equity and liability. An asset is good news and liability is bad news. And everything in the P&L flows in to retained earnings, which is a part of equity. So generally, we say that balance sheet will always balance. That means if one asset is going up, either the equity or the liability has to go up, and vice versa, or another asset in the same kitty has to come down. Similarly, with the liability, if one liability goes up, either the equity goes up, or another liability comes down, or the asset goes up. Okay. So what happens with the income statement? We know this income statement is a yearly statement which we close to the balance sheet every year. And whatever is the balance of your income statement, that is carried forward to the equity section in your balance sheet. All the good news to you are credits, and all the bad news like expenses and losses are debits. Okay. And everything which is a debit would pull down your equity, and everything which is a credit would increase your equity. So what happens if there's an expense or a loss? It's bad news. So your equity is pulled down. And if it's an income or a gain, it's good news and your equity is pulled up. Okay, so when there is a loss or a bad news on your P&L, it pulls down your equity, and the bad news in the P&L would either create more obligation for you, which will increase your liability, or it will result in a loss of your resource, which is your asset going down. So, a liability increasing and equity decreasing is the most common thing, right? Because I make an expense. So, see, the example that we had a couple of minutes earlier with Rahul was that an expense is getting credited and a payable is getting created, which may be salaries, which will be any outstanding that you have. So, rent, any expense which is payable. So, what happens? This is close to your equity account. So it's a P&L debit. So your retained earnings come down, your equity comes down, and a liability goes up. So every time there's an expense hit on your P&L, ultimately it pulls down your equity, and that is also substantiated by either when you've already paid that expense. So it's either what, see, whenever you're having a debit of an expense, it's either cash or it's an outstanding that you're creating. So a P&L debit will either result in the cash outflow, which means the asset is coming down, or a P&L debit will result in the liability increasing, whereby you know that you have to pay it in future. So this is an obligation. So we call this a current obligation, which is being created because of a past event. And this is the outflow of resources. So because of the expense that you have incurred, and if you go now, matching principle, right? We have frozen the revenue credit, and because of that, any corresponding item of expense would be debited. So we have to debit the expense this year, irrespective of the fact whether we make the payment or whether we accrue the payment, right? So when we make the payment, asset reduces. So your equity reduces, asset reduces, balance sheet tallies. When you don't make the payment but you accrue the payment, then also the equation remains the same because your equity goes down, but the expense will pull down your equity and your liability will go up. So on the same side, one item comes down, another item goes up, so your balance sheet will tally. Similar thing would happen with an item of an income or a gain. Every time you hit a sale, that means every time. So can you see how is this all related to the matching principle? If you have understood going concern, if you have understood matching and accrual, and if you have understood the basic accounting equation, those are the only three things that you need to know in accounting. If these three things are driven home, then every transaction, however complicated it might be, can be broken down and funneled into the basic equation. Okay, so whenever there is an increase in receipt, that means whenever I have earned the right to receive the money, what would happen? The revenue would go increase. That means the P&L credit would be hit, which definitely will increase the retained earnings and hence the equity. Now you have a right to receive it. Whether you receive it or not is immaterial. So what would happen if a P&L credit has been hit? That means to sales for services or for goods. I know that I have earned, the earning process is complete. P&L credit has been hit. That means my retained earnings goes up and my equity goes up. That has happened because I have a right to receive some money. Now, whether I receive it or not will depend on the next thing. Either I debit cash or bank, which is I have made the sales and I have collected the money. Or if I don't have this, then I debit an accounts receivable or sundry debtors, as we call them in India, which reflects that there is a right that I have to receive that money from the other party. In either ways, an equity goes up, your asset goes up, and another liability comes down. So instead of paying in cash, if this guy says that, see, you were supposed to pay me and I'm going to absolve your debt. So it's either an asset going down or asset going up or another claim of yours going down. So very simply put, the entire accounting equation and the financial statement approach would always help in drafting your journal entries. And every time you feel that you're fumbling, go to the easiest option once one of the phase or one of the aspects of the journal entry will be easy, whether it will involve cash in or out, or it will involve. So, one aspect, if you know, the other aspect, just think about it slowly. And whenever you write a journal entry, just check it whether the accounting equation is holding true or not here. Okay. So every time the A is equal to E plus L should tally. If there is a problem there, then it will be an issue.